Imagine you walk into a giant marketplace, not the noisy bazaar kind, but one filled with screens, charts, and endless numbers flickering in green and red. You have some money to invest, but standing there, the choices look like a foreign language. Index funds, mutual funds, hedge funds, ETFs. They all promise growth, stability, or sophistication, yet they couldn't be more different in how they operate behind the curtain. Let S strip away the jargon and tell this like a story. How four travelers take different paths to the same mountain called profit. All four start with one idea: pooling money. People combine their savings so a professional or a system can invest that collective pot into assets like stocks or bonds. It's like friends chipping in to buy one big house instead of four small apartments. You own a slice, not the whole thing. But what happens next, the way that money is managed, is where their roads separate. Meet the index fund, the calm traveler who doesn't chase excitement. Its rule is simple: don't try to beat the market, just mirror it. An index fund picks a benchmark, say the S&P 500, and owns all 500 companies in roughly the same proportion. No daily guesses, no emotional trades, just quiet repetition. It is like copying the entire class notes instead of writing your own version. You won get extra credit, but you won't fail either. Behind the scenes sits a computer algorithm ensuring the fund's holdings match the index. Because machines, not managers, do the heavy lifting, fees stay tiny, often below 0.1%. And with hundreds of companies in one basket, one company's stumble rarely sinks the ship. Index funds come in two forms: index mutual funds and index ETFs. The first is priced once a day after markets close. The second trades minute by minute like any stock. That single difference, timing, often decides which one investors pick. If you're long-term and patient, a mutual structure works. If you like flexibility, the ETF version gives you that freedom. Either way, the index fund's charm is peace of mind. It's boring in the best possible way. Now enter the mutual fund, brush in hand, ready to paint its own vision. It believes talent can beat averages. Instead of following an index, a manager studies balance sheets, charts, and gut feelings to pick what they think will outperform. It's human judgment versus the machine. That creative control has a cost. Research teams, trading, and constant decision-making raise fees, maybe 1% or more each year. And because people aren't perfect, many mutual funds underperform their benchmarks after costs. Still, not all artistry is wasted. Some funds specialize: green energy, dividend income, emerging markets, and those niches attract investors who believe in the manager's edge. Mutual funds trade only once daily at what's called the net asset value, or a NAV. If you place your order before the cutoff, you'll get that day's closing price. After that, it's tomorrow's. No real-time buying or selling here, patience required. But the upside is discipline. You don't panic sell at 11 a.m. when headlines scream disaster. You wait, breathe, and often make better decisions because of that built-in pause. Then there's the hedge fund, the private jet traveler in this story. Exclusive, expensive, and willing to take paths others fear. These funds aren't for everyone. They're gated behind wealth requirements, usually accredited investors only, and the buy-in might start at $1 million. Why? Because hedge funds play with sharper tools: short selling, leverage, derivatives, global arbitrage. Their goal isn't to simply beat a market, it's to make money whether markets rise or fall. Some hedge funds hedge genuinely, balancing risk between long and short positions. Others chase moonshots with aggressive bets. It's a world of brilliance and blow-ups, where the difference between genius and disaster can be one bad month. Fees follow their ego. 2 and 20. 2% of assets every year, plus 20% of any profits. If they win big. If not, you still pay. Hedge funds often lock investors' money for months or years. No instant withdrawals. Patience is mandatory. In return, you get complex strategies aiming for what they call absolute returns, a fancy way of saying make money no matter what. They're like private laboratories experimenting with financial science. Fascinating to read about, dangerous to join. Now meet the ETF, the exchange-traded fund, the flexible all-rounder. It borrows the diversification of a mutual fund, but trades like a single stock. Want exposure to technology companies? There's an ETF, clean energy, healthcare, even one that mirrors your country's economy. There's an ETF for that too. The beauty is accessibility. Buy one share and you instantly own tiny pieces of dozens or hundreds of companies. You can trade it anytime the market is open, set limit orders, even short it or use options. Yet most ETFs cost pennies in fees. Most ETFs track indexes, but some are actively managed now, blurring the old lines. Still, transparency is their signature. You can check holdings daily. A small catch. ETFs trade at market prices, not pure NAV. They can be slightly above or below the value of their underlying assets, called a premium or discount. For big liquid ETFs, that gap is tiny. For smaller ones, it can matter. They're also more tax efficient. When investors buy or sell, the fund exchanges securities in kind, avoiding most capital gains distributions. ETFs have become the bridge between old-school funds and modern convenience. Picture a split-screen montage. An index fund investor sipping coffee, ignoring the market noise. A mutual fund manager pacing with research reports. A hedge fund manager at midnight, dozens of screens glowing. A young trader checking ETF prices on a phone. Different rhythms, same destination, financial growth. Costs differ. Index funds are minimal. Mutual funds are moderate to high. Hedge funds, sky high. ETFs, very low. Trading styles vary too. Index and mutual funds trade once daily. ETFs trade all day. Hedge funds only when permitted, sometimes quarterly. Management differs. Index funds are passive, mutual funds active, hedge funds complex, ETFs mostly passive but evolving. Liquidity? ETFs offer instant exits, mutual funds the next day, hedge funds months later, and index funds match their structure. Let's humanize it. Sarah, a school teacher, invests in an index ETF tracking the S&P 500. She spends zero time watching markets, pays almost nothing in fees, and lets compounding do its quiet work. Omar, a young analyst, believes in expert insight. He buys an actively managed mutual fund focused on technology. Some years he beats Sarah, others he lags. Over time, he learns the fee difference adds up. Lena, an entrepreneur, joins a hedge fund through a private bank. The returns are thrilling until one quarter wipes out last year's gains. She realizes sophistication doesn't erase risk. Ahmed, new to investing, picks a simple index mutual fund through his retirement account. No drama, steady growth. 4 personalities, 4 roads, but each reflects how comfort with risk and control shapes financial lives. Every fund type hides mechanics that matter. Even index funds can drift slightly from their benchmark, a concept called tracking error. ETFs have bid-ask spreads, mutual funds might have sales loads or marketing fees, and hedge funds have performance hurdles. Mutual funds often distribute taxable gains yearly, while ETFs mostly avoid that. Hedge funds vary, but their tax treatment can be complex. And risk? Passive doesn't mean safe. If the market falls, your index fund falls. Hedge funds may promise protection, but can implode. Active funds depend entirely on the manager's discipline. Understanding these gears keeps you from blaming luck when structure is the real reason behind performance. So, which traveler should you follow? Choose index funds or ETFs if you want simplicity, diversification, and minimal cost. They're the reliable engines for long-term compounding. Choose mutual funds if you believe a manager's insight can truly justify the fee. Consider hedge funds only if you are wealthy enough to lock away money for years and still sleep well at night. The truth is, no single vehicle is best. They're tools, each brilliant for a specific job. An index fund builds the foundation, An ETF adds flexibility. A mutual fund adds human insight and sometimes human error. A hedge fund tests the edges of ambition. The screen fades to a quiet chart of decades, not days. You see the power of compounding, tiny percentages turning into mountains of wealth over time. And you realize investing was never about timing the market, but time in the market. In this long journey, simplicity often wins. The flashiest traveler may boast today, but the steady one reaches the summit first. So, whether you're holding an ETF, a mutual fund, or an index fund, stay consistent, stay informed, and remember, the smartest investment is usually the one you can hold through every storm.